Great. I'd like to call to order the Finance and Administration Committee meeting for Marin Water on June 26th. May I have a roll call, please?
Yes, Vice Mayor Diana Mayer,
I'm here.
Vice Chair,
I'm here.
and Chair Jed Smith.
Here. Terrific. Any public comments on non-agenda matters?
There are none.
Terrific. All right. Item 3, regular items. We'll move on to 3A, which is the minutes of the Finance Administration Committee meeting from May 22nd, 2025. Any public comments on the minutes?
There are none.
Great. And Vice Chair Meyer, we could call you Mayor Meyer.
Mayor?
Any corrections or any comments?
No.
Okay,
none.
great. So minutes have been accepted, I guess. Do we need an approval, Terry?
I think it's
vote?
sufficient just for the both of you to confirm that there are no comments or changes and that they can be accepted. As
Okay, got it. As that is noted. All right, moving on to 3B. We'll go through a contract with Acclamation Insurance Management Services, AIMS, for third-party liability claims administrative services. We'll hand that off to the team.
Good morning, Chair Smith and Vice Chair Mayer. This morning, I'm going to be presenting a proposed 3-year contract with Acclamation Insurance Management Services, or AIMS, for third-party liability claims administration services in an amount not to exceed $200,000 during that term. While the district makes extensive efforts to train staff, maintain infrastructure, and hopefully prevent claims before those happen, on an annual basis, we do receive about 60 to 80 liability claims. The number really varies, each year depending on things like weather. For example, rainy periods, atmospheric rivers can create problems. Numbers of capital projects and then other factors also influence those numbers. We do purchase a wide array of insurance coverages to, reduce our risk and our exposure. However, just due to kind of changes in the insurance market, over the last several years, our self-insured retention and deductibles have increased to keep those policies more affordable. That results in more of these claims kind of being handled through our third-party administrator, the district's general counsel's office, and then paid out of the district's liability reserves. So with that being said, since 2013, AIMS has provided these services to the district. They've provided, cost-effective resolution, great customer service. They're available 24/7. So if there's a water main break in the middle of the night, it floods someone's property, they're answering the phone at 3 a.m. and helping that customer, first of all, calm down, explain the process to get this resolved, and then helping on the district side mitigate our potential damages. And then basically, given just the long contractual history, because I said we've had a relationship since 2013, what we did is we decided to go out with a request for proposals just to ensure that we're getting, competitive rates, because we haven't looked at this in a while. And by doing that, we received, well, first of all, we sent this out to 6 firms based upon just kind of the Bay Area, other public utilities, who they were having provide these services. We cast a wide net to 6 of those providers. We received 2 proposals in response, one from AIMS and then one from another company called George Hills. Just given the cost differences between the 2 proposals, district staff decided to just go forward with the AIMS proposal, which was substantially cheaper. And given the past, history and excellent service delivery, we thought that that was in the best interest of, the district and our ratepayers. So we've had the discussion with AIMS, and what we're proposing today is a 3-year contract, not to exceed $200,000. On average, we only spend about $50,000 per year right now for these services. However, there are slight price increases being proposed that are about 3%. And the services are billed on an hourly rate. So we don't pay for anything unless they're providing services, which is kind of the cost-effective nature of their service model compared to what we saw in the other proposal. And then we would also have an option to extend for up to an additional 2 years, so up to 5 years total, if we chose to go there. And then that option to extend for 2 years, we would negotiate pricing at that time with Ames. So, with that being said, if there are any questions, I'm happy to take those.
Great. Vice Chair Meyer?
No questions. I'm very happy to see that you did your due diligence and that they're not only doing a good job, but that they're the less expensive option.
Yep.
Or sounds like a very they're very economical.
Thanks for going out and doing the right process here. Any public comments on this matter?
There are none.
Okay, terrific. Well, thank you, Jared, and we'll move on to item 3C and our Finance Director, Brett Uppendahl. Our monthly financial update.
All right. Good morning, Chair Smith and Vice Chair Mayer. My name is Brett Uppendahl, Finance Director, and this is the monthly financial update for June. As a reminder, this report details the revenues and expenses as of the end of May. So that puts us at 92% of the fiscal year. We still have one more month to go to round it out. So we're getting pretty close. Generally speaking, as it has been the last few months, it is really consistent with kind of the budget and with the trajectory we've been talking about. I know we recently adopted the budget for next year, and a lot of that was based on the assumptions here in the current year's model, and this month is no different in that regard. So water revenues there have been trending a little bit under budget, as I'll detail in the next slide, but they're still coming in relatively consistent with what we had expected after we made our mid-year kind of adjustments to where we expected the revenue to end. Total operating revenue, 88% of the fiscal year, or 87% of budget through this part of the fiscal year, about 4% of a lag. And again, that's accounted for in some of the year-end planning we did. Capital revenue there at the bottom, as you recall, is largely driven by fixed fees with the capital maintenance fee. So that's a little bit higher as it is more predictable. This is our expenditures, and we are working quickly here towards the end of the year to get a lot of these final expenditures encumbered and spent and accounted for. Personnel services has been lagging throughout the year, but better than last year in the sense of, we're at 85% of the budget this year. So it does reflect increased hiring overall, but that still will result in a year-end savings, as we've been talking about the last few months. And so we will have some year-end savings coming from salary savings in the personnel services category. We'll have more detail on that as we close the month next month. Maintenance operations, that is actually very low compared to where we have been in the past. You can see actual to actual, we're actually ahead of last year, but 65% of budget is pretty low. That really reflects our savings that we've seen so far, not having to purchase additional water too far above the minimum, as well as construction contracts this year. We've had, been fortunate not to have as many expensive leaks or breaks, I should say, pipeline breaks, main breaks. And so we haven't had as much expenses there in construction contracts. So again, similar to as what I reported in the last few months, we're expecting some level of savings in both of those areas, both from purchased water and from construction contracts. And that makes up a bulk of the savings in that category. The other two categories here, financing costs and capital allocation, those are kind of set to be, metered out throughout the year. So those are much closer to that 92% of fiscal year. Financing costs, we accrue monthly. We do pay debt service early in the fiscal year, but we spread it out for accounting purposes throughout the year. And capital allocation is actually quite healthy there, 4.3 million in capital allocation. What that means is that the engineering team and some of the operations folks are working hard on capital projects and charging out their time towards the projects. So that's what we want to see in that category, is trending pretty close to that 90% range for the year. So that's a good sign there that we have folks working on projects. Capital expenses down there towards the bottom, 65% when you count encumbrances. And so, as I mentioned, we are, preparing to roll over the fiscal year. We're paying invoices, and we are encumbering more contracts and then trying to close out the fiscal year as close as we can to the 100%. Obviously, we're not going to get there this year. There will be some carry forward into next year, and we'll talk about that after we close the books in June and July. I'll come back in August and give you a better sense for how much capital carry forward there will be. But again, there you can see actual to actual on capital line there, 43 million compared to 22 last year. Again, reflects a large increase in activity throughout this fiscal year in the capital area. Overall, expenses down there at the bottom, you can see 72%. So we're going in the year in the savings, as I mentioned a few times. And so we'll report on that in August, preliminary findings, and then we'll come back in September with more detail on expenditure savings. Following to the next slide, this is a kind of standard slide as we dig into water sales here. You'll note that we did have a pretty big month of May, and you'll see it on the next slide as well. But in my eyes, when I look at these kind of slides, I think service charges are typically more fixed. I'm surprised to see that over 100% of the budget in this last month. There may be a little bit of a billing kind of overlap. We may have lost a little bit last month and caught up this month with some of our fixed fees there. But when I see 108% of budget in water sales and 107% of budget in watershed fees, that really just shows that the month of May was a bit of an anomaly compared to prior years in terms of overall water usage. And again, you'll see that in the next slide. So we did have a little bit of a bump there. I would also note that May is the smaller of the 2-month cycle, the 2-month billing cycle. And so we do expect to have, nearly double, if not more than double, the amount of revenue next month in sense of months of June. So that, again, as a reminder, is a 2-month lag here. So the May numbers you're seeing are largely April consumption, a little bit of March consumption there. And so when we get to June, we'll have more of the April, May, which has been a little bit warmer. And we would expect, I think, to be, again, really close to that, 100% mark in terms of the monthly budget. But nonetheless, if you look down bottom left there, percent of actuals and percent of annual budget, we are about 10% below in water sales, the overall actual budget, about 14% actually, 86%. That's helped out by some of our fixed fees. Overall, we're about 4% of budget low in our revenues. And that's consistent with what we thought we would be once we adjusted the major projections in February and March. So as I mentioned, we did have a bigger than usual month of May. So this is kind of through May. So this takes the whole year.
All right, Brett, can you go back to that? Did you say we didn't adjust our budget?
We didn't make an official budget adjustment, but as we were talking about the year-end projections and as we kind of use those to fold into next year's budget numbers, there have been numbers that I've been expecting to be lower than the original budget. So revenue-wise, we're expecting to end the year about 4% lower in revenue, especially from rate revenue.
You adjusted the expectations given the okay.
Yeah,
got it. Thank you.
But we didn't make an actual adjustment to the budget because we know we're getting savings on both sides. We're getting lower revenues, but we're also offsetting that with more expenditure savings. So we didn't have to make a budget adjustment to adjust for the revenue this year.
Great, thanks.
Water consumption through May, and so this again will be 11 months of the fiscal year. We're getting there, towards the end. You can see that again the slow and steady rebound there, starting in fiscal 22. About 4% per year. We've maintained that pretty well the last couple years. And so this is again consistent with what we've generally expected in the rate studies and consistent with where we've been expecting this year's budget to be. It's hard to see the 1-month variation here in May, but I will just let you know that May itself was a little bit higher than it has been in the past. So that kind of bumped up this particular chart. And without going into this one, I did want to share not a new chart, but a chart that we had in the general manager's report that shows water consumption by tier. And so there had been some comments from the board about potentially showing this by percentage as opposed to by overall acre feet. And so I went ahead and converted that here. So it's the same. I'll flip back one time, not to make it too dizzy, but I'll flip back here. The same chart basically in terms of overall water, billed water consumption at this point of the year. This breaks it down by tier. And so there's some information to be gained here. I think, as I mentioned to the board a few times, I think a lot of this information will be a lot more useful once we finish the entire year. And so once we get one more month of data in here, and we'll be taking a good hard look at this, not only in my office, but we'll be working with the water efficiency team to kind of gain some insights here. And we'll also be kind of heading into selecting a consultant later next year to take an even deeper dive in terms of a rate study. And so In general, these are preliminary looks. They have, like I said, some value in the sense of kind of getting a sense for where the tiers have changed and how some of the consumption's changed. But it won't really be until we get the full year here, and we can really start to deep dive into the specific tier allocations and kind of how water was used across the service area and across the different customer types. But from this, when I look at this, you can see fiscal 24 and 25 out to the right. Those are the 2 years under the new rate cycle. And so everything before that would have been a different rate structure, would have had a slightly different tier structure overall. And so I think, even though overall, water consumption in the last 4 years is similar, you can see that jump of, 82 and 81% being in tier 1 in fiscal 22 and 23. That went down to the mid 70s in the last 2 years. So under the new rate cycle, we have less water in tier 1 overall that we're selling. And, I think by definition there, we have more water being sold in tiers 2 and tier 3. The big
But
reason
like
on that,
the
again,
tiers are totally different than they were. So the tier
Exactly.
1 is a lower hurdle now than it was before. So it's capturing fewer people.
it's exactly right. Yeah. So the tiers have significantly changed in the last 2 years in terms of the break points. So that's always going to be a difficult kind of conversion that we'll have to do. And I'll do my best. And like I said, we'll work with a rate consultant to kind of try to make sense of that in the sense of how much did it change from prior years. But it is what we generally expected. We have a smaller tier 1. We'll have less water there. We've expanded our tiers 2 and tier 3. And so we're going to get more water there. Tier 4 has actually remained pretty consistent. We didn't really touch the tier 4 break points. Obviously, prices changed over time, but you can kind of see I actually added an extra decimal in that one just to kind of show the variation. But it's really in that kind of 1.5% to 2.5% range throughout the last 10 years. There's been a little bit of change, obviously, in the years of the drought. I think you can probably see that the fiscal 22 and 23, where we were really able to get tier 4 under 1.5% of overall water. But the natural average you can see here is probably closer to maybe a little over 2% of our water gets sold in tier 4. So
Super interesting. So I look forward to when you go into a deep dive into this, but that tier 4 increase is concerning.
yep. So we'll take a deeper dive, as I said, once we get the full year's data. We'll work
Great.
with the water efficiency team to kind of share thoughts on this, kind of compare notes, and then we'll also be working with the outside consultant over the next year to take an even deeper dive. So like I said, I'll continue to produce this chart. It's a relatively straightforward chart for the numbers. It's the analysis that'll take a lot more kind of in-depth thought, but we'll get there over the next 6 months or so.
Great.
And so in summary, 11 months through the fiscal year, we're about 4% below budget on rate revenues. However, that's more than offset by savings in operating and capital expenses. The capital side will largely carry forward into next year. And so we'll report on that in August and September. And the operating savings that we'll have will generally fall towards the reserves. And I think, as I've mentioned a few times in budget planning and other finance committee meetings, we will talk about how to best structure those reserves and should we potentially add a reserve account in September and or October for potentially future building facility improvements. But we'll kind of take a look at that once we get the full picture of the final revenues, any kind of accounting adjustments, and any more information that comes in over the summer. Our total water consumption is about 4% more than the prior year, but it's very consistent with the budgeted amount for the year. And as I noted, I don't think you could see it in the slides as much as I could in my side of the data, but our actual water consumption in May was significantly higher than prior year, last year May, in terms of 15% higher. Some of that might be a timing anomaly, and some of that, like I said, will be just a natural kind of back and forth between the two billing cycles. And so I'll have more information on that next month when I report out.
Great.
Other than that, that's the end of my report here. I'm happy to take any questions.
Terrific. Vice Chair Meyer, any thoughts, questions?
Just two questions. I would have expected tier 2 and 3 to be bigger. Are the numbers are what they are because people are just getting better at saving water? Is that how to understand those numbers, those percentages?
Yeah. I'm hesitant to draw a conclusion at this point. I think I'm with you on that. I might have expected to see a little bit higher tier 2, considering how we changed the tiers, kind of splitting up tier 1. But I think you can kind of see it there in tier 3 more. I think tier 3 might have actually been the bigger overall change in terms of the break points before and after.
Yeah.
I would also note that when I looked at this is obviously the entire district's water. And so we didn't change tiers so much on commercial and irrigation and institutional accounts. And some of those are our biggest accounts. And so I think when we talk about tiers, so much of the focus is on residential accounts because, that's the majority of our customers and that's where the real impacts are. But I think when you kind of can bring all the data here together, it kind of mutes some of that impact a little bit.
Mhm.
And so I would like to take a look at my team and water efficiency at maybe splitting out just residential in this kind of a look, and then also maybe looking at it, system wide, because we do, like I said, we didn't change much of the tier structure in commercial, and some of our biggest overall accounts are there. So I think that kind of offsets some of what you might expect to see.
Great. And then on the expenses, I'm assuming that that's mostly luck, right? Like what if we have a year where we see that our income is much lower than we anticipated, how much ability do we have to cut back on expenses? I'm assuming it would be hard to stop that train, but
Well, I mean, I think, what we had to deal with that during the drought. And I think a lot of that is, more of an art than a science, maybe so much. I mean, so that I think fortunately the district has reserves. And so the ideal plan would be to draw down reserves during those times. And we have, specifically for if water sales are low, we don't want to stop the actions of the district just because water sales are a little bit lower than we anticipated. That being said, when we start to see that we're either drawing down too much on reserves or it's more of a structural deficit, we do have the ability to slow down expenses when we need to. It's again not necessarily part of the plan A, but we are able to slow down capital expenses if we need to. We're able to slow down hiring if we need to. I mean, some things are fixed, like you say. Some things we can't control. The water production costs we cannot control as much, but there are some discretionary levers we have there.
The the most notable time that would happen, of course, would be during a drought when we're messaging to use less water and the state's messaging. And then we have our program where we ask folks and then require folks, but we also have drought rates to offset that that could be implemented at that time that bring in additional on a unit cost basis revenue, not fully to make us whole, but at least to address in part. And then we have reserves.
Great. Thanks. Nothing else to
Yeah.
add. Thanks.
Okay, cool. And yeah, this year, I think the last 2 years, savings has come from the tremendous amount of capital project works that we have had and hiring and getting those done. We're a little bit behind, but we're starting to catch up. So I think that's
Got
the main
it.
difference. All right, terrific. I have no more comments. Brett, thank you for the report. Is there any public comments on this item?
There are none.
All right, we're motoring. Brett, thank you. And we have an upcoming meeting on Thursday, August 28th of the Finance Administration Committee. And so now we will move to adjourn. Gavel, please. Thanks, group.
Thank you.